Hi, my name is Eddie Donovan, and this video will be focusing on Harley-Davidson's ratio analysis. In order to gain a better understanding of Harley-Davidson's financial position, we conducted a ratio analysis of not only Harley-Davidson, but also its competitors within the industry. These competitors are Yamaha, Triumph, and Royal Enfield, which is under Eric Motors. In our ratio analysis, we have liquidity, leverage, activity, and profitability ratios. We use numbers directly from their 10Ks and yearly reports. This ratio analysis is so important as some of our companies are foreign-based, and as a result their financials are presented differently. This ratio analysis allows us to easily compare Harley, Yamaha, Triumph, and Royal Enfield to each other. Based on the ratio analysis, it is clear that not only Harley, but the entire motorcycle industry is suffering. Harley-Davidson has a fine current ratio of 1.2, though it can be improved slightly for a more secure and comfortable position for the firm. Compared to its competitors, Harley-Davidson should get their accounts receivable and inventory turnovers closer to each other for a safer collection period. But as long as their uncollected accounts stay low, then this may suffice. Their other competitors' ratios are much lower in terms of turnover. Harley-Davidson has a huge amount of debt when compared to equity at over 5.0, and I don't believe they will be in any position for payoff soon. If this continues, it will not only weaken the company further, but also drive away investors. If we also look at their debt to asset ratio, we can tell how much of their assets are financed through this debt. At 83%, that is a huge amount of their assets that are covered by debt. This raises many flags for the firm, and it is not something the company can keep up. Luckily, they are still managing to turn a net profit of nearly 10%, likely due to their restructuring and future plans, which they deem more roads to Harley, as mentioned on their website. According to KPMG, the industry's average for motorcycles margins is only about 4%. Harley-Davidson rivals' margins are considerably lower compared to Harley, showing there is more proof that the company can still succeed. In my opinion, they should accept a lower profit margin and funnel more resources into research and development because they can't cut costs and restructure forever. They need to innovate to stay ahead in the market, while their competitors are deeper in the hole, which can provide them with a huge competitive advantage. Triumph, which has similar designs to Harley-Davidson, is in the worst position of those analyzed with a net loss of 13% at the end of 2018. Knowing these factors thanks to our ratio analysis, we know that Harley, even though they are struggling, is not too late for the company to turn around. A reason why Royal Enfield's position is so much stronger than its other competitors is that they are not fully focused on motorcycles in the way Harley-Davidson, Yamaha, and Triumph are. As you can see, their turnover ratios are much higher, likely due to the fact that they also deal in large shipping trucks. Through this, we can see where Harley's struggling and where it's succeeding. Though we don't know yet what Harley needs in order to succeed, we do have some ideas that will help lead to a better financial position, growth, and profitability in the future.